Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
So as we continue on with our Back to Summer School series, we're right in the middle of summer here, and this is kind of a follow-up to last week's series on the last 6 months as tracked by this organization called SigFig. And SigFig, just if you haven't seen the episode, they have access to tracking $500,000 investors nationwide online on their trading habits and how they buy and sell investments with a total asset base of $200 billion. So it's very significant.
Right, yeah.
Significant amount. And so SigFig did some other analysis, which I thought was fascinating. They talked about the amount as people age, how their portfolio turnover declines. Okay.
Oh, okay. That
So
makes sense.
the interesting thing was that this kind of made sense to me. Up till age 25, that's when investors tend to have more portfolio turnover.
Okay, right.
And then as they age from 25 up, it starts gradually declining in the amount of turnover that they're trading in their portfolio.
Okay.
This is the troubling thing. As SigFig investors, when they reach age 65 and over, their portfolio turnover start increasing again.
Oh no.
So my immediate takeaway is, okay, 25 to 65, that's when people are in the peak of their earning years and career, and so they just can't pay attention.
Right.
But the troubling fact for me is you would hope like investors from 65 and older would learn something.
Right. Well, I think that there is probably just a small subset that once they retire, they have too much time on their hands and they spend it goofing around with their investments. When it would be better off doing any sort of volunteer work, any sort of exercise, any sort of hanging out with their friends.
Right. So so becoming an active trader in the stocks is probably not a great retirement.
No, I don't think so.
All right. Now, I think to finish this, finish our summary series, just to maybe reaffirm, there is one type of trading that probably makes sense, which is we call it rebalancing.
Rebalancing.
Can you explain that one more time?
Rebalancing is just when you bring your portfolio back to its original state. So if you said you wanted a portfolio that was, let's say, 60% stocks and 40% bonds, then you bring it back to 60-40. So if stocks have a great year, you sell some stocks.
Right.
And you buy some bonds, and so you're constantly selling just a little bit higher and buying just a little bit lower.
Right, I agree. Yeah, so and by doing that does not materially increase your turnover, because especially if you're dealing with indexes, you're actually not changing the makeup, you're not changing the stocks, you're just really changing your allocation, let's say, from fixed to stocks.
Exactly.
Okay. Well, thank you for watching the summer series of passive versus active investing. We'll see you next time on Erickson TV. Bye now.
See you next time.